You're good to go.
Okay, first of all, let me ask, do any members of the board have a time constraint today? Because this can be a long meeting. No one has a time constraint. Well, that's good. Let's have a roll call. Matt, if you do the honors,
Good morning. Peppy Finn,
is out of town,
Right.
excused.
Brian Hanson,
We have to come back to her to formally excuse her from not being at the meeting.
Brian Hanson,
Brian Hansen's no longer a member.
Paul Hample,
Here.
Lieutenant Colonel Gerald Lohr. Here.
Undercover.
Sharik Mansouri,
Here.
Jody Patterson,
Here.
Anthony Waskowitz,
Here.
Milton Wilkins,
Here.
Vicky Frederick.
Here.
Matt Littlesey is here.
Okay, fine. You'll correct this for Brian Hanson? Should have been on there. Okay, may I have, first item of business is the approval of the minutes. Does anyone have a question, comment, or suggestion regarding the minutes from the meeting of July 23rd? No? May I have a motion to approve? Anyone?
So moved, Hample.
Second.
Second, Sharif, all in favor, say aye.
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 Any
I can vote to excuse.
Yeah,
Excuse Pepe.
yeah, we'll come right back to that.
Okay.
Any nays or abstentions on the voting of the minutes, approval of the minutes? Okay, formally, again, we have to excuse Pepe's absence. I mentioned before you came in, you know what her family situation is, right? Okay, may I have a motion to accept her explanation for missing this particular meeting?
Second.
All right, all in favor?
Aye.
That's unanimous. All right, the employee request for retirement benefits. First, we have the civilian request. There are a total of 14 at this point. Any questions, comments? Anything controversial? We have a motion to approve. Anyone? It's like Ferris Bueller. Second? Tony seconds.
I did. You just didn't hear it. I did.
All right, fine. You took the words right out of your mouth. All in favor, say aye.
Aye.
Second, we have a request for police retirement benefits. Any comments? We have a motion to approve.
Section.
Jerry moved, Jody seconded. All in favor?
Aye.
Aye.
Okay, civilian and police death benefits, we have a total of 4. We have a single motion to approve both.
So moved, Hample.
Paul,
Second.
Jody, second. All in favor?
Aye.
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 That's taken care of. All righty. Next item on the agenda.
Death benefits for police.
Paul, you have the floor, probably quite a bit of the floor.
You approved them together. He snuck it in
My
there.
motion was to approve both, it's only 4.
Thank you, sir. Paul, just for the record, Paul Bacher, actuary, Foster and Foster. I bring all the exciting stuff. That's why you all only get to see me in person once a year. So this year, today we're talking about the annual valuation. It's this big document with draft across the front of it. Valuation is basically just the review every year of the plan's financials. We get member data from the county, line it up against your plan provisions, develop liabilities, compare that with the assets that I'm provided, and then from that, develop the contributions and the funded status and all the good stuff we're going to talk about today. So this document is labeled draft at this point. Not that I have any concerns with data like we have in the past. A few times we've talked about that. The only limitation on this document is just finalizing the interest rate. We haven't been able to have those discussions yet. And so once you all tell me, Paul, this is the rate we want to use, we'll finalize this in short order and we can be done with this for another year. Okay, so consider this a baseline. It certainly shouldn't it won't vary from this other than any decisions you all make. But we're going to start on page 5, the summary of the report, which, to no surprise, gives you sort of the highlights of what the other pages will talk about. So there in the middle of the table, or in the middle of the page is a table showing the 2023, so the valuation we did last year on the right, the current year's valuation with red all over it in the middle, showing you that down at that very bottom line, expected county contribution. Last year, we were expecting a county contribution about $46 million. This year, it's going up to almost $49 million. The paragraphs below that then explain the why. And really, it was driven by plan experience. The primary piece of that, as it shows, is the actuarial return, where we're not using the market value, we're using a smooth value of assets, taking experience and blending it over a period of time so that you don't have big variations in your funded status, which results in big variations in your contributions from year to year. It can be a little more stable. And so that smooth value return over a 5-year period was giving 5.16% for that smooth basis, which is short of the assumption of 7.25%. Okay, that's just 1 year, no concerns on that, but that is the primary driver of why the contribution's going up. Really no surprise there. We had a bad year a couple of years ago, and we've been smoothing that in over time. Okay, so no real surprises. As far as the rest of the VAL is concerned, we had a little more retirements than we expected. We had a little less turnover, which could be surprising. But overall, the demographics of the valuation were fine. No real concerns there. It was really just what we would have expected based on all the factors in play.
The bad year that you referred to was 2022, right?
I believe so.
So would that still be in the calculation for next year, or would that fall off?
No, it will have 1 more year. You can see that on page 28. We give you a schedule. So the last chunk of that will be next year, and then you'll be clear of that $225 million loss.
There's nothing good to say about that year.
No, so let's just give it 1 more year and we'll be done with it.
Right.
Okay, so moving on, we go to page 6. This could be the least exciting page in the report, but it's important to talk about. This is the page where we talk about changes that you all might have decided upon. Okay, so there are no plan changes, no benefits that change that we needed to reflect in this valuation. Along with that, there's no assumption or method changes. We didn't change anything other than the member data and the assets, just annual inputs. Okay, go to page 7. We get into the numbers. I'm not going to walk through every number here, but want to give you a sense. I like to talk through section A, that top line, the active count. Now, this is something when I came to you a couple of years ago, there was some concern when I was talking to Sue even of whether we were getting all the actives in the data. And so we actually had done some work to have a load in there to account for maybe we don't have all the actives. I think we've gotten to a point now where do we think the data is perfect? No, data is never perfect, but we think we have a nice, accurate, or reasonable count for the actives now. And so all those loads we had been doing are now gone and in the past. And so we feel like this 3,800 peak actives is appropriate. Okay, so you'll see a big jump in the active count from last year, whether that's because we're correcting things or whether because you just were able to retain some people, I don't know, but we feel good with where the data's at right now. Okay, if you go to the middle of the page there, you look at the assets, and this is really where you can see side by side. We've got the market value, which is just what's in the trust, and that actually increased about $70 million, $60 million from last year up to about $841 million. Right above that is that actuarial smooth value that we talked about, which is a little bit $906 million, just over $900 million. But you can see that was pretty flat from last year. It's up about 10 million, just because we're smoothing things and recognizing things a little differently. Okay. Any questions on that page? Okay, let's turn the page. Go to page 8. I will direct your attention to right in the middle of the page. We're going to look at 3 things. First is that unfunded actuarial accrued liability. So this is sort of, do we have enough or are we falling short? We take the accrued liabilities, the liabilities for service to date for all the members, and compare that to that smooth value of assets. And we can see last year, you were short about $293 million. This year, it's bumped up to $314 million, $315 million. Again, this isn't a surprise. We're smoothing in that $225 million asset loss. So honestly, this might actually be progress. Instead of taking on a big chunk of that loss, maybe $50-60 million, and it going up quite a bit, we only went up 20 million. So consider that a win. You go right below that, you get the funded ratios. I'm not sure we showed both of these last year, but because we talk about both of these, I went ahead and put them in here so that we have it for posterity, okay? So the first one is just that smooth value over the liabilities. And that's really what I look at from year to year for a funding perspective, really that long-term goal of we need to get this plan to 100%. And so we actually went down a little bit. We were at 75% last year. Now we're down about 1% at 74. Again, not a surprise. The smooth assets went down. If you go below that, all we're doing is swapping out the smooth assets for the market value. Okay, so this is really a value of what is the liability today versus the assets we have today. Okay, so again, last year was 65.5%. This year it's just shy of 69%. Okay, so we actually made progress in that regard because the market value of assets did go up significantly. Okay, so we're making progress. It's just we have two different measures for two different purposes.
As a frame of reference, I think our funded ratio as of January the 1st, 2022 was right at about 80%. Tad bit over
Mhm.
80%. We were really on our way.
Yes, sir.
And then 2002 went full go. And this is what we have to live with since.
Yes, sir. Okay. Last page we're really going to talk about is page 9 here. Not to give you an actuarial lesson, but section E here is what goes into the annual contribution calculation. And there's just really 4 things for you to understand. First thing, you can just walk your way down. The normal cost up at the top is the value of benefits actives are earning this year. So for people earning a year of service, this is the amount you need to set aside to pay for that year of service. Okay, just think of it that way. You go down one more line, administrative expenses. There's nothing hidden there. We're just trying to pay back to the trust any expenses that are being charged against that. You go to the third line. This is dealing with the amortization. So any unfunded liabilities we have, we set up a new base for any new gains or losses and amortize that over 25 years, just like a mortgage almost. You get a set payment and you retire a piece of that every year. Currently, that's about $29 million. You add up all those 3 pieces, you get the gross contribution. You then offset that for about $3.5 million of member contributions that are now coming in for the new contributory tier of members. And that arrives then at that $49 million contribution that we had talked about previously. Okay.
Mhm.
Now, there are more pages in here with more details. There's breakouts of Plan A versus Plan B, the civilian versus the police. There's summaries of assumptions and plan benefits and assets and member statistics. I'm happy to talk about any of those if you have any questions, but I see no need to waste your time with just details that don't really further the discussion necessarily. So,
Okay, Paul, let me ask you this, and you may not be able to answer, but perhaps you can get back to us later. Our actuarially defined or derived funded ratio of 74.2%.
yes, sir.
Do you have an idea how that compares to other public plans in the,
In Missouri,
yeah,
it's easy enough to find out. I don't know off the top of my head, but
that's, I didn't think you know, somebody I think is trying to get in. That would be helpful.
yes, sir.
Okay. Just to comment on that, Milt, if I can, I don't know about Missouri, but just the last NCPERS data I saw, which is National Conference of Public Employee Plans, was right around 72%. That's the median or average? The average funded status. How many plans are we talking about? Hundreds. All right, Paul, anything further?
No, sir.
All right, we ought to stop now and discuss the item that Paul brought up. And that is, what should our discount rate be? Our official discount rate, should we remain at the 7.25% level? Should we increase it? Should we decrease it? I sent to the board a piece of analysis that Paul was kind enough to do for us, do for me at my request earlier in August, which identified, just for purposes of discussion, several different potential higher actuarial rates and what the probability of achieving those rates are. The current, not actuarial rate, target return rate. But the current target return rate of 7.25 is about a 70%. Excuse me, you have it right here. Over a 20-year period, 7.25 is a 67% probability of achievement, which doesn't say we're going to achieve it, but there's a 67% statistical probability that we will. And so the question is that 67% too low, too high, or that's right? I'd like to open that up to questions or comments from the board. To me, 67% seems to be a bit, how do you describe this? Conservative in the sense that I would entertain a higher number with a somewhat lower probability. For example, 75%, excuse me, a 7.5% target return has a 64% probability. And it may not seem like very much, but then again, it has a financial impact on the county. So I put this out for discussion. Does anybody feel that we ought to entertain a somewhat higher but still reasonable target rate of return given the range of probabilities that ACG's analysis illustrates? Or do you believe we ought to say where we are or decrease it for that matter? Jody?
I think there's a lot of unknowns out there. And even though that's only a 3% difference in probability, maybe I'm on the conservative side that I'd be more comfortable staying with probably the 7.25.
Jerry?
No, I've got an opinion. So yeah, I get, me, I get my fiduciary responsibility of the pension. Yeah, I tend to be more conservative. So I'm comfortable at 7.25. And if I was inclined, I would probably recommend you go down a little bit, but I understand that raises the profit. If you go to a 7%, I don't know what the probability that raises it to.
Raises it 71%.
Comfortable. That's that. I tend to be right in that. That's where I tend to be.
You would be at the 7% as
Yeah.
opposed to 7.25.
Yeah.
Okay. Tony?
I agree with both Jody and Jerry that saying 7.25 makes a lot of sense. So, yeah.
Jerry would feel more comfortable at 7.0.
Oh, I see. Yeah.
He's
Well,
willing to accept 7.25, but you feel judgmentally more comfortable at 7.0.
I think the 7.25 is reasonably supported.
Paul?
I would agree with that. 7.25.
Sharif?
I think we've had a hell of a run since the last hiccup in 2008. So, I'd go along with 7.25, but if anything, I would be leaning towards a more conservative number. but I would go along with 7.25, definitely nothing higher. I think 7.25 is already getting a little bit aggressive the way we are allocated. So, that'd be where I stand.
So I take it there's no appetite among the board members for anything higher than 7.2.
Not me.
Paul,
No, not for me.
not for Jerry, obviously, based on his comments previously, and not for you. All right, that makes it unanimous, but we have to have a motion. May I have a motion that we remain at 7.25? When I say unanimous, I would go on higher, but I mean, among the rest of the board, I'll vote.
Can I ask one question?
Please.
A little bit different in the rate, but related to it. Is there a cap as to what the county liability can max out at? So let's say there was a hiccup, like we're already smoothing out 3 years here from 2022. If there was another hiccup and the rate was too aggressive, is there like, if we get to an underfunded status where the commitment is there a number where it starts getting, their contribution starts getting a little problematic?
I can't answer that question. We've been lower than 74% since I've been on the board.
Okay.
But financial implications may not have been quite as high as it might be today.
Fair enough.
I can't answer that question. You said, what's our threshold for pain? And we can drop below that threshold for pain.
You do have pop right now. So you need it, the budget driven.
Is,
For records too.
please,
Is there anything in the investment policy, I can't remember off the top of my head, that recommends a probability threshold? You know, that we want to stay within a certain range?
no, that would be up to the board. And I can see how that might evolve over time. Whereas today, we would say, for example, would be 70%. The higher the higher our funded ratio already is, we may be
Mhm,
more inclined to adopt a somewhat more aggressive target.
mhm.
And I can see that evolving over time, but as of right now, there is no
Yeah, I'll just bring up,
threshold.
I did share if anyone's interested in terms
Please.
of what what's going on in the pension world. Went out to the, how to pronounce this, the NASRA website, and they had a report that stated just March of 2024 in terms of where rates are. So there's some nice graphs. I think everyone has a copy of this. There's some nice graphs that give you specifics, kind of, where people are. The largest part is at the 7%. But then the next category is at the 7 to 7.5, which is kind of where we would be. And there's some information in here about Missouri as well, because a lot of times we are comparing ourselves to the Missouri state pension plans. So just want to give you that in terms of, I think it's going along just with this conversation that we're having here. But to point that out to you in case you're interested in taking a look at that as well. Because obviously.
Which I sent to everybody yesterday. I hope everyone received it.
Yeah, okay. And so one of the other things is, it is, that interest rate is one of the most important actuarial assumptions that get made. So I think, I didn't realize that everyone had gotten it yesterday, but I wanted to kind of point that out.
No, if I may.
This one.
One thing I like about this is it not only gives you information over time, but if you look at page 2, this is something they added a couple years ago where it's really showing that maybe part of the reason driving these rates down over the last 20 years is over that time, inflation has been falling as well. And so now because inflation is so much higher, it leads to these kind of conversations of, well, has the world changed and do we need to change along with it or not? Not sure I really have an opinion either way. I look to you all for that kind of insight, but it's just a good reminder of, what, that real return has stayed pretty flat, and it's the inflation that might be driving a big chunk of why everyone's lowering their assumption. And so now that inflations are higher, can we assume something higher along with it? And I think it's something that's going to have to evolve over time, but that goes with your interest rate. It's just like any other assumption. It's something you set, you can monitor, but you're really setting it and trying to hold it for a period of time. And then if the world changes, yeah, we revisit it, but otherwise we feel comfortable. And unless the entire world changes, we don't need to make large changes because it's got a solid base behind it.
Jody, maybe I will just to your question on the probabilities. And so again, what Milton's referencing our model, and which we reviewed at the beginning of every year with this group, our asset allocation models based on the different asset classes and our outlook going forward, based on the key variables as well as potential earnings, valuations, how rich, expensive things are, yields we're receiving, kind of, et cetera. And those can certainly vary year to year, our expectations looking forward. So we've talked a little bit about 2022, for instance, being a tough year in the marketplace, which it was. Certainly, we've experienced that in the plan. Well, that had an impact on we took certainly a big hit in the portfolio after 2022. So that did, if you think about it, go forward from that point, improve our expected returns. So just for reference, I looked it up, but just right before that drop in the marketplace in 2022, where the Fed raised rates quite a bit, and equities sank quite a bit. That 7.25% expected return, that same probability over the 20 years, instead of being 67%, was in the mid 50s, like 55. And so it certainly can; those probabilities can bounce around. And so it's it's certainly good that we have more of these discussions. But no, there is no set kind of parameters that we're trying to target a specific probability because, frankly, we'd be moving the mean stick around too often.
Any other comments? Again, we have to vote to officially adopt this, but any other comments one would like to make? All right, then may I have a motion to adopt the 7.25%, maintain the 7.25% as our target return of investment or discount rate?
I'll make the motion.
Tony first, who seconds? Billy?
No, can I actually interject here something?
That's good.
Here's what I actually think is going on a little bit too, and I'm processing this, and Jody, I'm not trying to speak for you or even Paul, but we have 2 of the 5 members, other than yourself here, that are actually thinking about 7% versus 7.25. Could we actually have a little bit more of a conversation just around what would this look like at 7% versus 7.25?
Certainly.
Just to deepen that.
As we said, 7%, that's a 70% probability, which I personally view as too conservative. But one might want to be very conservative in running a pension plan. But
Yeah, and I was even thinking, what if we didn't go down to 7, but what if we went down to 7.2 or 7.15?
Oh, from an actuarial
Yeah.
standpoint, what is the significance of this board voting 7 versus 7.25 from your perspective, purely from an actuarial point of view?
My actuarial opinion is I don't care. I mean.
No, like in terms of the expected
Well, if you
contribution.
were coming to me saying, we want to go to 8.5, I'd have opinions, but I think you're in a point now where you're talking about 5, 10, 25 basis points. I don't think anything's unreasonable about taking it up 25 basis points. I don't think there's anything unreasonable taking it down 25 basis points. So whatever you all decide within a window of reasonability, great. If it works for you, it's good.
Could you speak to maybe the impact, just to whether it's ballpark contribution
Contribution
funded
rate,
status,
yes.
what
Yeah.
would be impact?
And that's
what
sort
I
of
was
goes through the analysis. So the
Instead of
analysis I
48.
put together was a 50 basis point going up.
Right.
But it should be pretty symmetric. So at 50 basis points going up, it was increasing the funded ratio by 4%. It was lowering the contribution by about $6.5 million. So if we decided to lower it by 25 basis points, you might expect the funded status to go from 74 down to 72. You might expect the contribution going from 49 to maybe 52. Okay, so there is an impact, but
So from an investment point, we would always say a lower is more reasonable and more conservative. It's going to have an impact financially to the county.
the question you have to ask, is it far too conservative? not far too conservative, but is it too conservative for purposes of investment planning? For example, you can go down to 6 and it's a 90% probability we hit 6.
Well, and that's a
But
problem.
would that be responsible? Is that responsible?
And so I don't know what you all see, but a lot of times I've seen people over that 20 years lowering their return from 8% down to 7%. And they're not doing anything to the investment mix. They're just becoming more conservative in their interest rate. And so at some point it becomes not just a, hey, let's be a little more conservative, but it needs to be what you were talking about. If we get 100% funded, we no longer need a target of this anymore. So at some point, maybe you don't care about it being 70% of a target. You want to go down to 7 and become more conservative in your returns because you don't want that risk anymore. So I'm not saying you're there now. It's just, I wouldn't suggest you go to 6 and not do anything to your investment portfolio because who cares if you have 100% possibility of getting 6% or whatever the percentage is, because it would, I think we'd all agree that might be too conservative for what you're taking on.
It would be unreasonably conservative, let's put it like that. That's our responsibility is to apply best judgment as to reasonability in terms of reaching an investment objective. And then everything the county does and has to fund would follow from that reasonable judgment.
Yes, sir.
And if we're unreasonable either way, we're not living up to our responsibility. Any more than I would recommend anything that has a 40% probability. That would be unreasonable and dangerous. But I wouldn't recommend anything which had a 90% probability. Also would be unreasonable, not dangerous, but unreasonable, expensive, but not reasonable.
Absolutely.
Well, and if we're having the conversation about reasonableness, essentially what I just heard, and being a layman in this world, like it's not unreasonable to be at 7%. That puts us more in line with NASRA. I mean, that puts, again, we're essentially in a little bit of an outlier on more of the aggressive side, if you look at the data there. So I think 7% makes me feel more comfortable. And I think, yeah, again, my job is to be conservative with the pension. I think we are in a little bit of uncertain times. We've had a great run since I've been on the board, other than 2022. But so again, I don't think that's unreasonable. So that, yeah, that tends to make me feel more comfortable. So I would advocate for a 7%.
No, excuse this question too a little bit, but if a 7 versus 7.25, effectively what it means is that the board's asking the county to contribute $3 more million than what's being contemplated at 7.25. Paul, is that somewhat?
That's a fair statement.
That's going to have to give us specific numbers.
Well, okay, just for, and if we have a duty to protect the financial stability of the pension plan, effectively, would we say that duty is better served asking the county to put an extra $3 million in? Or is it negligible or barely matter? Is that, I'm just trying to frame
Are
it.
you making a statement or asking a question?
I guess, I'm not sure yet. I'm trying to kind of think through is there a material difference between 7 and 7.25 and what are the consequences of that decision?
As I said, Paul would have to actually run a calculator on this little calculator.
But I think he's given us at least enough, you know.
But Tony, I mean, you're framing it the right way. So Paul can give the specifics, but ultimately at some point, the money has to be made some way.
Right.
Either from investment return or contribution.
Right.
And so this, 25 basis points is kind of shifting from one to the other. And so a 25 basis point decrease in
Effective return.
effective return
Means the
we'll put a little
county
bit more of the contribution there.
And if you do better, you're going to be better off.
And doesn't that play into what the board, again, the board, we have publicly stated our intention is to drive the funded ratio up.
Yes.
So if we lower it, the county contributes more, but then we actually outperform. That's a win-win. Correct.
And we have a
That's what I
better
was going
chance
to
to
say,
get-
that it would be easier to sit a year or two from now and say, hey, we are ahead. And look and increase this number rather than get behind and have to do further catch up. That's always a harder task. So, I mean, you still try to keep going and driving the best return you can. That doesn't change that, but
just wrapping all this up, would we say that we have a higher probability of getting to an 80% funded ratio by using a 7% expected return?
Of course. Yeah. Absolutely.
That actually would sway me, honestly.
Okay, think of yourself standing in front of the county council
Right.
and explaining your.
Hold on. Okay.
I've done this, by the way.
Yeah.
And explaining your logic. And the logic has to be compelling. Because they have to make financial decisions,
No,
monetary
I get it.
decisions, which are terribly important.
Yeah.
Okay, what is your logic again?
That using a 7% expected return gives the plan the a higher probability of achieving an 80% funded status over the long term versus using 7.25% expected return.
Because the county has to put in more money.
Yep.
And whatever we achieve, we're going to achieve regardless of what the number.
Correct,
is.
exactly.
What you're basically saying
I
is.
disagree with that.
Go ahead, please.
When you say we're going to achieve whatever we're going to achieve, yeah. But if the county's contributing more money, we're better off than if they contribute less money.
I agree, that's what I was going to say. What we're basically saying is that we want you, the county, to put in more money because our funded ratio is low, which we've asked them to do previously, matter of fact, for the.
But at the end of the day, the county doesn't have to match the contribution rate.
Yeah.
If we ask them to contribute $53 million and they say, well, we're just not going to do it, we're going to contribute 50, that's a choice that the council can make.
Funded ratio.
I mean, historically, again, the council has always typically matched what the actuary has said. But at the end of the day, they don't have
That's the difference
to.
between last year and this
It's a
year.
dangerous precedent.
Yeah.
Not asking them to set that precedent.
So I wonder.
But
if
again,
that-
I don't think this is unreasonable. There's more logic, which is, we're not dropping it to 6%
Right.
to drive that fund. Again, we're not using that as the
Yeah,
mechanism. of
employers
leverage
just
to drive the funded ratio.
right? So.
Yeah, we're just trying to be a little bit more conservative.
But with the
If the
contribution
win-win,
rate.
we'll
will be the
reevaluate it
way to
next year.
If you.
That's, I mean, if we
It's set.
far exceed the 7% this year, then you can always move that number.
No, if
So,
I may also-
or you, would you say to the county council, what we want to do is adopt a number we feel very comfortable with. And that is a number that has a 70% probability of achievement. And then it happens to be 7%.
Again, when we've publicly stated, we've asked them to contribute excess of the required contribution by the actuary. We've done that because the board has publicly said we are trying to drive the funded ratio up. That is a stated goal of this board. And I think that by doing this it is a small piece of us achieving that or working toward that end.
Well, if we haven't been able to increase the funded ratio over the last decade, which has been a tremendous decade, I would be hesitant to say that we can achieve that in the next 10 years with a 7.25. That would be my reason. And I would say we are also ahead of the median and average by 0.25%. So that also gives you a reason to pause and say, listen, is the next 10 years going to be what we have seen? Maybe nobody knows the answer. Maybe they're going to be better. Maybe we'll print $20 trillion next 3 years and we'll have a great old party.
No,
We don't know that. We don't know that. It's possible. Anything's possible.
Well, it also is determined not just by what's going on in the market, but what our investment strategy is.
Correct. So
Our asset allocation strategy, as well as to the extent that we have active managers, how well they do. So it's not just the finished bond.
correct. My only thing was that do we want to have 0.25% extra than the average at this point? What is our basis? I want to flip this around and say, what is our basis to be 25 basis points ahead of the average at this
I
point?
like how you phrase that.
I think one of the things that Milt is saying is when the council looks at this, they're not going to look at, oh, well, we're just going to put $3 million more. They're going to be looking at, well, it's going up already $2.5 million. So now we're talking about $5.5 million. So I think that's the argument, because every time the council comes in and looks at budgets, they're always comparing what are you asking for compared to what you got
Well,
last year?
I don't disagree with
Very
that, and that's how you start, but again, the
Yeah.
question is how do we explain it? I think
But that's,
everything that we have
I think
discussed
you've
just
got to,
explains it.
I'm just trying to put the focus on the fact that, the question will be, why do you want $5.5 million donated? It's not going to be just the 3 million. I think they're going to be focused on the entire amount because that's how they look at it. I mean, I think that's just reality.
And well, and that's how they look at it, but we look at it differently. Does that make sense? So like my job is to look at it.
I'm
Yeah,
just-
I know you're not.
Yeah.
I mean, we are where we are. We are where we are. I mean, it's 7 and an 8, the compromise. I don't know. I mean, that's,
Is there any, if we're taking a,
That's being supersized without particular logic to it.
I mean,
When we just work in terms of 25 basis point increments, it's easier to understand one way or another. But
if we take a full 360 view of all the stakeholders who are involved, one of those stakeholders are the beneficiaries who cannot get a COLA until we get to an 80% funded ratio.
Right.
If we leave the discount rate at 7.25%, beneficiaries could say you're actually making decisions that decrease the probability that we will get to 80%, meaning you've decreased the probability I will ever get a COLA. And should that be part of our consideration as well?
Again, the integrity, the financial integrity of the plan should be our driving and overweight.
And to that end, Mr. Chair, I'd say I'm not comfortable with any scenario that's going to require the county to contribute more during a time when the county's budget pressures are almost and in the face of a coming senior property tax freeze that's just going to increase those pressures even further in the next year. So I'm comfortable with staying where we are at 7.25 for the record.
I think one of the challenges when I hear that, and here's what I really don't know. Does this board have an obligation to care about the pension pressures at the county? Or do we just simply need to have blinders onto that and look at this purely through the lens of fiduciary responsibility to the plan itself and let the chips fall where they may outside of that? Because I just hear that, I don't disagree with what Paul's saying at all. I just don't know that that infiltrates the decisions that the board needs to make.
I look at it as purely from the fiduciary perspective of the plan, which is also the same, still should not be overly conservative. We still should not say, for example, that the target or discount rate should be 6.5%, which is very conservative, but I think that's unreasonably conservative. Same as I think 8.5%, even though it's a 50% probability in their model. If this were a foundation, I'd think of it differently, but as a pension
It's
plan,
different
it's different.
impacts, way different impacts than the
Yeah.
foundation.
At 8.5%, it has a 50% probability. Both are unreasonable. So we have a fiduciary responsibility to the financial integrity of the plan, applying reasonable judgments.
So we're saying though that either 7% or 7.25 is reasonable. I mean, no one's debating that. It's just which side of that do we want to be on? And just based on this discussion, I'm actually more in favor of the 7% than I am the 7.25. So I'd like to change my position on that and support 7%. Because I actually think that decision is actually get that versus 7.25. I actually think the 7% is in the best interest of the plan itself.
You're saying to de facto force small f, the county to contribute some money.
I'm not letting that factor into my thinking.
You're not.
No, because that's the county's decision. They can react to that however they want. And I respect whatever reaction they have to that. And I think hopefully the county would respect the fact that the board is trying to look at this through multiple factors and trying to come up with an answer that we think serves the best interest of all of the stakeholders involved. Not just the county budget, which is one piece and an important piece. But I would say it's up to the county to decide how to accept the board's recommendation and what that is. And I think we should accept whatever they want to do with that. So I'm not trying to force anything so, other than prudency and a fiduciary carrying out a fiduciary responsibility to this plan.
Jody?
I'm on the fence. I tend to be more conservative. And I understand I should not be taking the county's contribution into consideration, but it's still there in my mind.
That's a practical matter.
Yes, exactly, which makes me then lean towards the 7.25, and that it is even from a conservative standpoint, it's reasonable. Even if 7 would be more comfortable, 7.25 is still reasonable. And we can reevaluate next year, knowing that we're not making a decision beyond 1 year. And that if we really need to lower it, we can next year after we have another year under our belts. Because these last few years have been so uncertain.
So 700,000.
And I feel like it's very difficult to forecast what our actual performance is going to be.
In the short term.
Exactly. Short term and long term. Yeah.
Maggie? Oh, I'm sorry.
I would be the first to agree. I think we are debating shades of gray. I really
Yeah.
do. So that I totally agree. But within, if that's our choice within that spectrum, I would probably lean more to be a little bit more conservative with the expected return assumptions.
Okay, we can call for, unless somebody else has further comment, we can call for a vote as to whether or not we retain, I think logically, we retain 7.25, no, logically, whether or not we move from 7.25 currently down to 7.
So that was a motion, is there a second?
No, I haven't made the motion. I'm just articulating what the motion would be. Is everybody comfortable with that?
The motion is to reduce
Well,
it from
if
7
if you're comfortable, that would be the motion when the motion's actually made, that we would move from 7.25 down to 7. And we vote up or down.
Sure.
Okay. Who would like to make the motion?
I'll make the motion.
Jerry Moore, who would like to second?
I'll second it.
Tony Waskowitz. Jerry Moore. As the motion is, I'm putting words now in Jerry's mouth. The motion is that we adopt a 7.0% discount rate or target rate of return for this upcoming period. I shouldn't say upcoming period, but we adopt that for as our pension long range, actually for a long range pension planning, 7.0 rather than 7.25. Does that mean what you want, Jerry? Sure.
And how many votes does it take to pass it?
4. Well, actually, it takes, Becky isn't here.
Right, it's still
So
4.
It's still
Still
4, yeah.
4.
Because that's to take a majority. Are you ready to vote? Yeah. All those in favor?
Aye.
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 Okay.
And my vote is no.
Yes, I understood that, Paul. Even if I have a no, going ahead, but we'll do that and hopefully we can beat it by far. Now that puts more pressure going to you guys. That puts more pressure on our asset allocation strategy and on the board. That we really have the most thoughtful asset allocation strategy manager lineup possible. So we can not only, we can eventually reduce the burden to the county while also better positioning ourselves at some point in time to consider cost of living adjustments for the retirees. But right now, the funded ratio, whether it was 7.25 or 7, is substantially under 8%.
Right, which I don't think it really is going to dictate any change to your asset allocation strategy. You just have a higher probability of outperforming your target rate of return. Which is what our data would have suggested.
Yeah, higher probability.
Higher probability of achieving it with that strategy.
Your 10-year return, if I'm reading this correctly, is 7.08, correct?
7.1.
That as of July.
You're looking at.
As of July, you'd have to look at
It's
several different.
for the last 10 years, which have been great, which have been ridiculously good. You have a 7.08% return, and that's a total net number, net, correct?
Yeah, that's right.
No-
Yes.
No transaction, because sometimes there's a statement of additional cost.
This is
on
your,
some funds.
this is the county's performance based on all. the
Dollar- on the
cash
dollar value.
flows,
On the dollar value.
Net fees.
Yeah.
And it's, while the last 10 years have been very good, the endpoint is still impacted significantly by 2022, where you had a negative 16%.
I
So if
would,
we went back and looked at the end of 22 or the end of 2021,
2014, 2024.
that 10-year period, 2011 to 2021, the 10-year return was much higher. But your point is,
I mean, I would come back with the fact that the standard deviation on the market is 15%, so that's an average. If anything, we've been shielded by money printing on the volatility. It's not been more, it's been ridiculously less than what history shows us. I'd go the other way than what you're saying. I mean, 2022 was not a anomaly. It was,
no, it was in the range of outcomes.
I mean, you had
For
a
sure.
huge run, so I would say it was overdue. It was not an anomaly.
Right, which is what our capital market assumptions, if we looked at this in 2021 and 2022, the expectations for this portfolio were under 7% going forward. And it was after 2022, to Finney's point, when interest rates went up, inflation's gone up, valuations in 2022 came down, our go forward 20-year expectations were up from what they were at the peak of that 10-year period from 2011 to 2021.
And I also, I mean, well, we can dive into investments now or not, but I also think Sheree gets some. So yeah, the last 10 decade, it has been about 7%, has been 7.08% for the total plan. Volatility has shrunk in what we talk about a lot, the US large cap market has particularly shrunk, but other areas of the market actually haven't been over that period that great in terms of returns. We look at small caps here in the US, lower, they've been about 7% over the last decade. They've had a lot of volatility with the change in interest rates. Remember, we have a lot of our investments in international equity markets, which have experienced tremendous volatility over the last decade. And actually, they're below their averages. And then, of course, real estate, which we talk a lot about in here. I mean, the last couple of years has really endpoint specific driven that down.
Well, I mean,
Just a very, very simple, if I may, I'm sorry, because I'm
Please,
actually here.
please, go ahead.
I think it's just really simple, no matter how you support the expected return. Somebody's going to say, if you use 7.25, the board just voted to use an expected return that's above what they've earned the last 10 years. And now we're saying, well, we've actually voted a number that's 8 basis points lower than what we've actually achieved the last 10 years. I think it's just that simple.
Well, and I think it's important too, I mean, time period specific. I have this page open, so this is as of the end of June. But so the last decade, our return is actually below 7%. It's 6.75
At the end of June.
at the end of June. July moved it up and we kind of move them up. So our 10-year return is below 7. Our 15-year return is up over 9%. Right?
That's fair.
Our 20 and 25 years are both below 7%. And our 30-year is up around 8%. Now, asset allocation is a lot different going back 25, 20 years. But certainly point being, this is a long-term plan. And it's, we're going to go through a lot of different types of markets. And you can look over specific periods of time, this 10-year period, et cetera. They can be certainly quite different.
So to that, I'm sorry, but I'd prod the 15-year return because you're talking about the great financial crisis and that lower number that you are calculating from. So that's not a good number, the 15-year number. I think the 20-year number and the 10-year number would be better numbers. And I would throw the 15-year number out because that reason that you're calculating from a low point. You had come down quite a bit.
Well, that's
Even the 20-year, because the financial crisis was not, that was way out of the, I think, probability of volatility range.
Well, it was in the probability, the first percentile, but that's how we keep score at different time periods, right? At some point, we're going to have a 1% probability. It's going to be in the numbers that we go through, and that's what it
This
happens.
is why you use smoothing. from an actual
Right.
standpoint.
And on the second thing about you mentioning small caps and other sectors not performing, unfortunately, we can't drive performance from the rearview mirror. I mean, we have to sit and figure out what we feel are the sectors that are going to perform in the next decade, not what happened previously. So, along that line, maybe we've talked about this at some point. I know we're going to do that, is the allocation. I just wanted to comment on that statement you made. It's regardless, it's been a great decade. I mean, by all measures, it's been a great decade, investment wise.
I mean, and there are certain, it's been a great decade, in particular areas, some more than others, but to your point, what we care more about is the next decade, the next 20 years, and what the allocation is going to be. And there are certainly areas of the market, areas in our portfolio that haven't appreciated as much as others in the last decade. So again, go back to diversification and asset allocation and the importance of that.
What page are you on?
I was just talking, you don't need to.
Okay. So the board has approved moving to 7% as opposed to 7.25%. Which I think are too conservative, but I'm.
Mr. Chair, what was the final tally on that vote?
It was, I voted in favor, so you were the sole, nay.
Okay, and on an unrelated matter, my screen is now a chart. I'm not seeing the board anymore. Is there something we can do about that?
Yeah, I see. Count your blessings, Paul.
There we are. Thank you.
It would have been 5-1, Paul.
Thank you, Mr. Chair.
All right. Next item, we will need a new document from you to actually approve at the next meeting.
Not a problem.
I don't think we could actually approve it. I guess it's probably better that we approve it at a meeting in situ as opposed to via Zoom or something of the sort. Because you would have the number tomorrow. I mean, that's not a big deal.
No problem.
Where are we budget wise, Jelly? Or can this wait until the end of September to be incorporated into the budget?
I'm not sure exactly where they are with the process. Do you know any more than I do, Vicky?
Just dropped off.
I would think that, we can get some estimates from Paul to provide for the budget, given the fact that he's gonna be crunching enough. I mean, right now, I would basically tell Paul Kreidler the 52 million that you kind of estimated as a ballpark. So that's a good number, right?
Well, that's for 2024 though. Your budget, you're looking at 2025, aren't you?
Right, and he usually, yeah. Yep.
I only ask because I can't,
Matter of fact, since the board has approved going to 7%, we ought to go ahead and incorporate that, submit that to the people who are actually preparing the budget. In terms of approving the report itself, we can do that at our meeting
Right.
in situ.
Yeah.
We can do.
absolutely.
And I think they present, I think it's like the beginning of November is when they, the county executive make the presentation to the council. So I think we've got some time period in here, but no, he'll need the amount to actually do a forecast in terms of what it's gonna be the next year or two. So in terms of this year's budget, I know he did, he always is conservative because he's doing that every year. He's looking at what the current year is and adding on to it. I don't know if we've got the 52 million, but.
Yeah, finding that 5 million I know is going to be a big challenge.
And it could be that they come in and it's refused for
I think that's okay.
2024.
Yeah.
So,
Okay. Next item on the agenda. We're gonna, I think the program, the new program for drop.
That's actually easy.
Yeah, drop report update. and then we'll talk about ACG.
Okay. We just heard back from PensionSoft this morning with quotes for how much it's going to cost to get some of the administrative side up and running to incorporate what we plan to do with the backdrop. So my next step is to reconvene the committee and let them understand some of the administrative pieces that we still have to lift up and put in place and come up with a formal recommendation that we hope to have to the board in the near future.
All right. All right. It's 10:35, ACG report, and we still have to allow time for our executive session.
So, Mel, how much time do you want us to take? We can.
Matter of fact, I would prefer to go, personally, I would prefer we go into the individual manager analyses at the next meeting.
Okay,
And William Blair is also going to participate and present at the next meeting. Is that correct?
correct.
Yeah.
We have that circled in
I would prefer to do that at the next meeting, even though it would be 2 months out of date.
Okay,
All right. So why don't we just talk about the overall performance of the plan per se, rather than go through each of the manager.
perfect. We can do that very quickly. We do just that, and then we do have one update on a manager that we will share. So we're telling you what, we're just going to jump to the staple packet here. So Becky, this is what you had pulled up. This is the monthly ASAP as of July. And so really, big news in July, if you, on the left-hand side of the page, you can see our returns through July 31st. The dark blue lines are the month of July, the lighter blue lines are year to date. And you can see overall, very positive month in the markets in July. A lot of this driven by discussions around interest rates. So again, so what happened in July? So first up, GDP numbers came in fairly strong. We started to see inflation come down a little bit, it's now into the high twos. And then really what we're starting to see is the employment data starting to come down. So not a strong employment market. This has pushed a lot of market expectations for the Fed to start really dropping interest rates. So again, to put this in perspective, coming into 24, everyone expected about 6 interest rate cuts from the Fed. And really, because we'd be heading into a recession. That didn't happen for the first 6 months of the year. Rates remained elevated. And now at this point, market's starting to see this. What the Fed has done with higher interest rates has really has really worked on from an economic standpoint. And so now expectations are about maybe 3 to 4 drops between now and the end of the year. So what did this do from a market standpoint? It certainly benefited bond prices. You can see bond prices here, those 3 Bloomberg indices, all positive, up over 2% for the month of July. They're actually all now positive from a return standpoint year to date. As you can see, that wasn't the case going into June 30. And also certainly that big rebound at the very top, the Russell 2000. So US small cap companies, we talked a little bit about the volatility earlier, small caps have experienced. They certainly need to borrow money. Most of them do. They don't have the strong balance sheets as their large cap counterparts. So this is really benefiting. You can see them up over 10% in the month of July alone. Certainly been some strong performance. The other thing that we saw, it's not necessarily particular on here, but technology growth, which has continued to really drive performance. It's been a top heavy market in the month of July, given these expectations of rate dropping. That also flipped a little bit. We saw value outperform on both the US and international side relative to their growth counterparts. So just flipping to our returns on page 5 that we can hit on. So as of the end of July, and again, these returns are all net of fees, but just first off, where our portfolio sits, $875 million in the portfolio as of the end of July. You can see we're up about 1%, just under 2%, 1.9% for the month. Note, as you like to bring up, we don't have our real estate performance in there for the month of July, so that will be updated. Looking out longer term, year to date, trailing year, again, it's overall been a pretty strong year, up almost 9% over the last 12 months. So since last August 1st, just under 9%, 8.74. Again, look at the big difference though between the 1, the 3, and the 5 year. And this is that 2022. Again, we talk about the smoothing and how kind of time period specific things can be. For 3 years, our returns certainly down quite a bit, but over the 5 years, up almost 8%, 7.7, so close to that 7.75% return over the last 5 years. You can see 37 basis points annualized out of our policy index. We talked a lot about the last decade in this conversation, so as Sharif pointed out, you can see over the last decade, we're up almost 7.1%, 7.08. Again, that's net of fees. You can see our policy index, which again, if we were invested passively, what the market's given us is a little bit less than 7. And so that's, about 0.25% per year net of fees we're able to add, mostly from active management, pretty strong.
Can I just touch on something real quick here, Finney? I'm sorry. If you look at large cap over 10 years, and this is what Finney was talking about, really large cap has dominated the last decade, outperformed every other asset class. And it's been very pronounced the last 18 months, from the beginning of 2023 through mid-June. If you look at the 10-year return for the index, the Russell 1000, up 12.86. The Russell 2000, below that, the benchmark, up 8.72. Your managers, your implementation were mostly passive, and we have some complementary growth and value in large cap, but essentially in line, about 21 basis points difference. Small cap overall has added 100 basis points. More compared to the US equity versus the Russell 3000, which is what's in your policy index, we're actually behind by 48 basis points. Even though large cap, which is a large portion of that, is only trailing by 21 and small cap is outperforming. As large cap has run up the last decade and last 2 years specifically, the Russell 3000 is about 95% large cap. And the Russell 2000 small cap makes up about 5% of that. So your weighting of small cap overall, your allocation to small cap managers is more than 5% of your US equity. And you really see that in the near term, whereas the 1 year, your US equity is 300 behind that Russell 3000 benchmark, even though your large cap managers have outperformed, small cap has underperformed. But if we look at that 1 month, here's where we're really seeing it. You've outperformed the policy index. Your US equity has outperformed the policy index by 57 basis points. Your large cap managers and your small cap managers both underperformed in the month. But because we have more small cap than the Russell 3000, you're actually outperforming. I'm pointing that out because there's nothing wrong with that. That is intentional, but the impact of small cap has had some caused some relative dispersion with that broad Russell 3000.
And maybe the only thing I'll add on too, so again, looking at over this last decade, we talked about really what's happened over the last decade, very been US centric, equity driven performance, a lot of volatility in between. As Jason mentioned, so US equities, our total portfolio is up about a little over 12% over the last decade. Compare that to non-US equity. Our portfolio is up 4.2% over the last decade annualized, really right on top of the benchmark. So managers overall have done fine. There's been a lot of changes of managers through in there.
And international equities have been our drag over 3, 5, 10-year period of time here.
Certainly, yeah. Over the last decade, they've driven. We've seen it recently over the last particularly 18 months, them starting to rebound, come back quite a bit. I mean, you look at over the last decade, the last 12 months, our international is, up double digits. Still not quite as high as US large cap technology is. It's certainly quite a bit of rebound. Fixed income over the last decade hasn't given us much return, right? Fixed income over long periods of time, really what determines that return is the yield you're getting. So as we know, over the last decade, for the most part, yield's been very low. Looking forward, we're sort of sitting in a different spot. And then real estate, which is on this page, we don't have it for the full decade because of how we switched our composite. But even real estate over the last decade, annualized the Odyssey index about 5.5%. A lot of that, of course, driven by the recent drop since 2022. So again, this is where potentially we think going forward, having this diversification, different areas returns, we think will be helpful.
And what's the relative ratio between US and international equity, 65-35?
From the equity standpoint,
Where are we right now?
We're very close. So it's 65-35 broadly, and from a world perspective, and we're right around there. No, I have to do the math here real
So you
fast.
said we're at either 60-40 or 65-35.
Right, we're very close. So yeah, we're just right about 60-40 in our portfolio. So we will have William Blair in next month, International Small Caps,
About 6.35, actually.
to talk about their portfolio, which has had some struggles. They're about 2% of our overall portfolio, but from active management, they've been a drag on our performance. And then the other update we wanted to give, so one of our two fixed income managers, Western. So since our last meeting in July, they announced that they are actually being investigated by the SEC, Department of Justice, on really trade allocations within their treasury, some of their treasury portfolios for some of their managed accounts. Just last week, they announced one of their co-CIOs, Ken Leach, he's implicated in this and he's taken a leave to focus on that. So certainly, they haven't released much information since then. They're actually going to be in our office next week, WAMCO is, to explain this. And so we'll have more to share, more to come. This might be, certainly something where there's conviction we want to make a change. It could potentially be a big deal. So we're certainly looking to get to the bottom of that. But that's the only update from a manager perspective, besides William Blair scheduled to be here next month.
I get the wrong key on my calculator here. 1 second. US equity 33.4%, international equity 27.61, 61, 33.42.
Well, it says here,
55, 45 is where we are right now, excluding the private equity and excluding real estate. You include that, obviously.
Our private equity is mostly US exposure. Real estate, I don't think necessarily would be apples to apples in that comparison, but we have about 3% of our portfolio currently in private equity. So that would certainly, I think, put us on the US side. Get to that closer 60-ish 40.
Yeah, add the real estate and the private equity in there, so then it's up to about, what, 60-40? Yeah, okay. Marty?
You indicated that the feds are, or at least folks think they're going to be doing 3 to 4 more increases throughout the rest of the year. Decreases, yes. I'm sorry, I misspoke. Do you think most of that has been priced into the market, or do you think we're going to see more impact on the market if that proves to be true?
So I certainly think there'll be some more volatility in the market. So the market digests news very quickly. And so the expectation right now, even just, as of this morning, is 100 basis points cut between now and the end of the year from the federal funds rate. So that's what the market is pricing in. Now, what actually happens is at 3, is at 4, the market will quickly adjust. And like the market always does, they will overanalyze and, be a little bit crazier than maybe they need to be.
Change, because coming into this year, the expectations were 6 rate cuts
Right.
this year, and we've had none, so.
So there'll definitely be volatility, I think we certainly think in the marketplace.
Continue.
Yes. And the elections don't help with that.
No.
All right. Anything further? Other business? Visitor comments, and then we're going into closed session.
Can I
Sue?
say something?
Sir? Sure.
It's in here?
Yeah.
It's so good to see everybody again. As you that don't know me, I was the old Matt, and I retired at the beginning of last year. And I guess I just wanted to come and talk a little bit, like 3 minutes, to say thank you to the board. I know you've heard from retirees who, and I respect the retirees to come in and beg for a COLA. But I also know the county's financial situation. And I think I just represent a lot of retirees who get their pension check every month on the dot and go ahead and, live as I'm living my best life. I've wanted to come several times, but I've always been like out of the country or something. So it's retirement is great. But, as I said, I respect the retirees that come and ask for a COLA. I know people are in a much different situation than I am.
as a new retiree. But I don't have much respect for retirees that come and try to tell you all how to do your job. When I was working with the board in Matt's capacity, you know, I never, ever thought that the board, the actuary, the consultant ever gave advice that wasn't for the best part of the fund. And I think sometimes that kind of gets lost in the, you know, the kind of the crap that goes around. So I just wanted to come and I never come back, but I wanted to thank you all and you really do a great job for the county. Thank you.
Thank you, Sue.
Good to see you, Sue.
Any other visitor comments? This point? Okay, fine. Could I have a motion to adjourn into closed session?
So.
Second.
Sheree and Jody, we in closed session here.
Roll call.
We'll have a roll call first.
Right.
Closed session.
Pepe Finn,
Or do you need a roll call?
We need a roll call to go into closed session because then you decided to go into closed session.
Pepe Finn, Paul Hample,
Aye.
Lieutenant Colonel Gerald Lord, Sharif Mansuri,
Here.
Jody Patterson,
Yes.
Anthony Waskowitz.
Yes.
Milton Wilkins.
Here. Okay, Maggie, can you take us? Where we left off?
Before we go into the discussion, can I ask for one thing during this closed thing? I don't know, you may already have this number and you may already know this, but I would like to see at some point the cost numbers on these managers, the fees, as a percentage. You may already have that as a total and as a breakup to the equities if that can be given.
That's fine. And in fact,
It's usually.
ACG does that.
They do that,
year
yeah, 1
In
year.
January. We can ask for that information.
Yeah.
Right, but it should be like some managers report only their operating expenses and not the trading costs. I would like a total aggregate. I mean, total numbers on the cost per category if possible.
I'll mention that to Jason.
Thank you.
Well, in terms of the ones that are
And you know,
individually.
not to drive the performance, sorry, I didn't mean to interrupt you, but I would love to
I've lost audio, by the way.
No, I know, but here, can I also make one other observation?
But the key thing is are the recommendations reasonable and in good faith?
Yeah,
Reasonable in the sense that this is,
Right.
we don't have infinite resources as a county.
Yeah.
But reasonable in terms of the dollar amount and done in good faith and with thorough discussion and analysis.
would it be fair to say that there are certain matters of the board where the interest of the county and the interest of the beneficiaries are actually not aligned? So they're potentially even in conflict,
Almost all the time,
right? So a
because
little-
beneficiaries would like to have more money
Mhm.
and less.
It-
There
So
is
here's the-
perpetual.
do you think the board needs to almost kind of put on a scale those two interests? too.
Jerry?
Nope, it's time for me to go. I'm sorry.
But I'm really trying to, and I'm not trying to hold anybody up, but here's when I hear things like, I totally respect the fact that the county has a budget problem. I'm not denying it. But when I hear Paul say things like, and I think of what Paul said, is that I can't vote for that because of the implications on the budget. I feel like there's also another side of this, which is the beneficiary saying, but you're constantly voting on things that prevent me from ever getting a COLA, or at least minimize my chances of getting a COLA.
Maggie, I can't hear.
I apologize.
Sorry.
There's no direct conflict in this particular instance.
But there is, though.
No, there isn't, because there won't be a COLA in any event at today.
Oh, I get that, but I'm talking down the road, because the plan has to get to an 80% funded
Yeah,
in order for a beneficiary to get even considered to be a COLA.
that's right. And the target return may very well be different by that time.
I totally understand.
Can I just interject a little bit?
Yeah.
The COLA is a recommendation by the board to the county council.
Right.
The county council can say, thank you for your recommendation, but we're going to do something else.
And it's the same with the contribution too, right?
Right, they
Okay.
can say, thank you.
Right.
You know, but we're going to do something else. So, that's all, you know, this board is, except in some, what I would call ministerial capacity, you know, like approving benefits and that kind of stuff.
Yeah.
You know, at the end of the day, the big decisions, you know, are going to be going through the county council, just like hiring investment managers.
Yeah.
You know, those go to the county council. Now the county council has never said, in my experience, and I've been doing this almost 25 years, has never said when the board has, you know, said, let's choose so-and-so as an investment manager.
Right.
The council has never said, no, you know, we want you to use Y.
Yeah.
Now, on some of these matters involving the amount of contribution or the COLA, sometimes, you know, the council may feel different. So.
And I'm glad to hear that, because I feel like then we're not forcing the hand of anyone. I think we're just trying to do the best we can to encourage certain
And so the duties of the board members are listed on 204050,
Okay.
and that might give you a little bit more.
One of the things I can answer your question is this, with Paul actually doing the actuarial calculation, coming through to point out that this is the recommendation for 2023.
Right.
So there's an action, immediate action that will be required in 2024, because obviously we have an amount, an estimate budgeted, but it may not be, it may be, I don't know, 50 million. It might not be 52 million, you know, and so when that comes forward, then the county exec will have to say, we don't have 52 million. We need an additional, do I want to go to council to get that approved in this year's budget, and where's it going to come from?
But at the end of all of this, to his point, that's their decision.
Right.
It
Our
is.
decision, and again, this is where we've struggled in the past, which is our job is to do what we think is in the best interest of the plan. And I'm not naive to the circumstances surrounding the plan, not naive to the circumstances surrounding the county. But I don't make my decisions to go, man, we should really lower the rate and we should really up our contributions. County doesn't have any money, so I'm not going to make that recommendation. No. I make the recommendation based on what I think is in the best interest of the plan. If Dr. Page says, I don't want to go to council or I don't have that money, then he can underfund the plan.
Yeah.
He can say, well, I only have 49 million. I don't have the 52. I'm only going to put 49 in.
Yeah.
And I get that's a hard decision for him. But
And-
again,
and
I
then- And
think.
then the decision will be for next year too. So that's, it does have a little bit of, I just want to make sure that
But I
everybody's
think we
aware
all
that
understand.
it's
We
not,
all understand that.
it's not,
yes.
oh, we're planning for 2025's budget, that it will have an impact.
But again, that's,
That will be dealt with.
knowing that, again, doesn't change my decision as to what I think is in the best interest of the plan today.
And if it did, we also might be at risk of beneficiaries coming to us and say, hey, you were never, ever voting my interest. You're only voting the county's interest. And I actually think that creates vulnerability to the board as well. So that's what goes through my mind, Milt,
I
is
don't think it does. Again,
Well-
the responsibility is the financial integrity of the plan. And so what we've essentially said, that we believe it's prudent and reasonable to plan on a 7% target rate of return.
Yeah.
We believe that's doable, 7% probable, and we believe it's doable, but we're uncomfortable with committing to anything more than that.
I'm just putting myself in the base of
Point
a,
of view of
yeah.
what is in the, meets the criteria of financial integrity of the plan.
I would agree with you. I think it does create potential that employees say that you're setting up a system
Right.
that prohibits my COLA ability to get a COLA.
At least.
And I can
Yeah,
take
but I
that.
mean, that's not factoring in any kind of nuance into this. You can't completely disconnect the financial welfare of the county from the financial welfare of the pension. I mean, these are all factors.
I think that's.
The word here
fiduciary-
is the word here is nuance.
I think the fiduciary responsibility of the board is to do just that, which is 7 or 8 to 2.
But I also think if we're asked to consider the budget for the county in our decisions, we're not in a position to do that. It's almost then we'd have to understand all the.
Well, one of the problems we had happened years ago and went on for years since I've been on the board, is that the board at that time, I was simply a member, not chair, vice chair, but the board at that time took into account the financial condition of the county.
Right.
And that did shade its decision on target actuarial rate. Trying to divorce that. I just want to look at financial integrity of the plan.
Which I think we're.
And that's why, that's the reason why the plan is as significantly underfunded as it is. Because the board said the county can't afford for us to do X, and therefore it left the plan being that X, increasing the amount of underfundedness, so to speak. And I think if we just keep in mind, what's the financial integrity of the plan, I think that's a pretty good guideline.
I just think there has to be a little sensitivity to a beneficiary looking at the board's decision saying, all of your decisions favor the county and actually mitigate the chances that I could get a COLA. That's all.
Yeah, but our responsibility isn't to give a COLA. Our responsibility is to meet the financial obligations of the pension.
Because there's
Has
no,
been
there's no
laid out.
obligation
I
to
mean-
people.
It's not built to, the pension is, a COLA is not specified by the plan. So that does not be our obligation.
Beneficiary and a pensioner can't make that claim, though. No, I mean, we've had highest inflation we've had in 50 years, and a word of pensioners can saying, and I don't get a COLA in this, come on, what the heck?
Yes, and you're like 90% of the private sector.
Right, well,
Private sector does get COLAs.
One
yeah.
of the other things that I would say in terms of, thinking about your arguments is that you don't want to make rash changes in the discount rate. And so basically the county has moved to the 7.25 and has been here for at least 3 years, I think. And so you make a change, and it's more of a moderate change, and this is only 0.25%. And it's kind of, the gradual. So you can make that argument as well in terms of of what the intent is not to make huge changes, but gradual, and yet move us to the point where you feel comfortable.
Yeah, the key thing, and I'm sure this is true with Jim Kinane and Brian, I know it was really true of that. We want to be fair to the retirees, quote unquote fair, and provide a COLA because there hasn't been one, but we don't have a legal obligation to do it. And our first objective has to be the financial integrity of the plan. And it's difficult to justify a COLA when the plan itself, on an actuarial basis, is 74% funded. And therefore, I think we're living up to it. All we have to do is increase the performance of the plan, or the county puts in lump sums of money, and then we're in better position.
Well, thanks for asking that. Let me bring that up, because I just.
No, that's fine.
So simply hearing this, that we're not forcing anything.
I mean, also the other thing is I mean, I apologize for stating the obvious, but if we drive a situation which worsens the situation where we are in now, we are not doing the county any favors by doing that, because then they have a bigger hole. And they'll be like, what the hell have you guys been doing all these years? I mean, you have caused this. There is the flip side that we are not necessarily doing something that is not in line with what they want. They do want a manageable situation. So we have to keep it manageable. So, I mean, there is that.
I totally agree with that. I'm saying we should balance, like, we have to be on the scale, consider things. And that's all, versus only the county side, that's all. So I totally agree with you. Just trying to get in touch with.
And we have not achieved 7.25 in the last 10 years. I mean, where is our basis?
All right, thanks, Millie. I'm sorry.
Motion, we have another turn.
To adjourn it.
Motion to adjourn.
So,
Jody and Sharif.
thank you.
Yeah.
Have a good one.
Yeah, till next time. So what's your question?
All right, so.